All righty. To respect Mr. Keller and everybody's time, I'm going to just say some housekeeping stuff and then we'll kind of get into the night. But thanks everyone for joining us on this Wednesday night. I've been looking forward to this for a while, so I'm very excited. So tonight, my name is Felicia Mix, and I'm one of the co-chairs of the AOC-PM&R Student Conference Committee with Anna Marie, who's on the call tonight, and Alyssa. And so our job is to plan that mid-year meeting that we're holding in Tampa, Florida, April 29th to May 1st. This is a pre-mid-year meeting event where we're going to go through some financial topics. For that mid-year meeting event in Tampa, just let you know, student registration is free with a virtual and in-person option. And so we hope you'll be able to join us. In a second here, I'll put a link in the chat for you if you need it. So as I said, we're going to start this kind of three-part mid-year meeting financial series. So tonight we have Mr. Keller, who I will introduce in a second, talking about disability and life insurance. And then we'll also have some other guest speakers in the future. Our next event is April 7th at 6:30 p.m., more specifically talking about student loan repayment. So I'm going to put all of that information that I just told you about, including Mr. Keller's website, in the chat. Let's see if I can do this for you. And I highly recommend you to kind of click on these links before this event is up to have for you. So that is for you guys. Okay. So I have the pleasure of introducing Mr. Lawrence Keller, who is opening our three-part mini-series on these financial relevant topics to residents and young attendings. He will be giving a presentation followed by question and answer session regarding pre-submitted and any live questions you guys have. Please keep your microphones muted until the question and answers portion or in a time where it's appropriate to speak when we open it up to the audience. Mr. Keller is a certified financial planner, professional, commonly abbreviated as CFP. He is also the founder of Physician Financial Services, a company dealing exclusively with the financial needs and concerns of those in the medical profession. Mr. Keller has spent the last 31 years providing insurance and investment products and services to residents, fellows, and attending physicians. These include, but not limited to, disability, income insurance, life insurance, and investments. So I'm going to give you the floor, Mr. Keller. Thank you so much for being here with us tonight.
Awesome. Well, thank you guys so much for having me. At least I know the first one out, I can't disappoint, right? Because everyone's just going to build on top of this. So that's definitely, a good thing. And you will find, like we were saying before, is if you can do medicine, you can do financial planning, you can do insurance. A lot of it is just like medicine. Once you have the basics down, a lot of it is just terminology. And once you have the basic financial knowledge to keep that, maybe you'll read a couple of different blogs throughout the year. You'll pick up a couple of different, financial publications. But once you have a base of knowledge, you will start to find, hey, I'm reading this stuff and everything seems to be the same. Why is it that everybody says the same stuff? Well, the reason everybody says the same stuff is conventional wisdom is just that. And if someone is so far off of what the conventional wisdom is, you really have to question, what's going on. So, what you'll see first off is I've got a lot of letters after my name. Does that mean anything? Yes, it just means that to have a lot of letters after your name, you're probably in the profession for a relatively long period of time. And in order to use them, you typically have to have an educational requirement, an experience requirement, and an ethical requirement. So certified financial planner is really like the boards of the world of financial planning. And anybody can really call themselves a financial advisor. The question is, do they have the credentials, behind them to actually do so? And do they have the licenses to do so? So when we talk about disability insurance really is all about what's here and what's here, and not what we have. Because if I was to shake down a bunch of medical students and residents, the odds are very good you have a lot of debt, You don't have a lot of assets, but you've got a great future ahead of you. And all of the financial planning that you're going to be doing is all predicated on the income that you're going to have as a result of working, right? So at the end of the day, we are just glorified money-making machines. And ideally, we love what we do. We want to make a positive impact on society. But at the end of the day, we're going to earn an income doing it. This is what's going to allow us to pay down our debt, create a lifestyle for ourselves and our families, and ultimately save for retirement. So what do you need to know? If you knew nothing at all about disability insurance, the first thing you need to know is you guys are better than a spreadsheet. I cannot begin to tell you how many agents and brokers, have something online, you answer a few questions, next thing you know, in comes a spreadsheet. And a spreadsheet is nothing more than a tool. But a spreadsheet can also be used to have you make decisions based on limited information. And when that happens, you might make a decision that you wouldn't necessarily have made had you had all of the information available to you. So you can use them as a guide, but you're really better off doing more research than just a spreadsheet. A spreadsheet is a way that insurance agents might shortcut or try to shortcut the system. Unfortunately, they also might be taking away your right to vote in certain areas because they might not deem them important to themselves as an agent, but you might think that that's very important. And if you don't know that that's available as an option, you might make a decision that you wouldn't necessarily make. Who are you talking to? So I happen to work with a lot of plastic surgeons, and I can tell you that there is a difference between a board certified plastic surgeon that has done a plastic surgery residency, and let's just call them, for lack of a better term, a cosmetic physician, right? There's no boards for that. Now we know whoever is going to see these people, the patient, they are going to get a result. There's no doubt about that. Are they going to get the ideal result? I would submit to you, it's less likely that if they see a cosmetic physician, they are going to get a result that is not ideal compared to a board certified plastic and reconstructive surgeon. So you have to know who you're talking to. How many clients do they have that are physicians? How many clients do they have that are physiatrists? Do they understand that a physiatrist is not a psychiatrist and that you guys are doing physical medicine and rehabilitation and you're not doing, counseling? Big difference. There are 6 companies that have what is known as own occupation. Some people use the term own specialty disability insurance. And I will tell you that, own specialty and own occupation, technically they're not synonymous. And own occupation, we will talk about, is always based on what were you doing immediately prior to your disability? And how has your accident or your sickness impacted your ability to do your job? So let's say I use the term own specialty. And let's say you did a family medicine residency, you finished your training, and you decided, I don't really want to do family medicine just yet. I'd rather be more flexible in terms of my hours. Maybe I can make more money not working as a family medicine physician right away. I'm going to work as a hospitalist. And hospitalist, we know it's shift work, and you're dealing with patients, from the moment they are admitted to the hospital to the moment they're discharged. And God forbid something happens and our individual is disabled and they cannot perform their duties as a hospitalist. They would be deemed totally disabled under the terms of their policy if they have the right policy. Well, they literally could go work doing outpatient family medicine and still continue to receive their total disability benefits because they could not work as a hospitalist due to their accident or sickness, even though their education, training, and experience still allows them to work as a family medicine physician. So own specialty, Not quite, because I would say, hey, I'm a family medicine physician, but no, my duties are that of a hospitalist. So there's 6 companies that we'll talk about that offer this. And I've really boiled it down to finding the right disability insurance policy is as easy as 1, 2, 3. And these are 3 areas that differ or potentially can differ from one company to another. And once you know what's important to you, this will help you narrow down to the company or companies that will best meet your individual needs and goals. So what do I look for in a disability insurance policy? Well, I'm really not going to go into employer provided coverage, because as a resident or as a fellow, almost every institution is going to provide you with coverage. Typically, you're not going to pay for this coverage. Well, insurance companies know that your potential is really high. And as a result of that, we do not take employer provided coverage into consideration for residents and fellows. So anything that you're provided by your institution is going to be above and beyond any individual coverage that you might choose to purchase on your own. So the first thing that we have, it sounds scary, in my box is a non-cancelable and a guaranteed renewable policy. So what does this mean? This means that the insurance company, once they accept you, they cannot take the policy away from you. They cannot change the premium rates. You can get rid of them. They can't get rid of you. So some might say, this is better than a spouse. You can throw it out and you don't run the risk of losing anything. Here, the insurance company is the one that's bearing the risk, because once you're in, you're in. You can make changes, they can't. You can decide to cancel the policy. As long as you pay your premiums on time, plus the grace period, they can't. So ideally, you want your policy to be both non-cancelable and guaranteed renewable. We definitely want to have an own occupation definition of total disability. And again, this is really going to say, if I am a physiatrist and I've limited my practice to physical medicine and rehabilitation, and I can't do that job due to an accident or sickness, if I'm smart and I'm motivated and resourceful enough to do something else, whether it's in medicine or outside of medicine, it does not matter. My policy should still consider me to be totally disabled, and full benefits should be payable in addition to anything else that I might choose to do. Now, as good as own occupation is, there's a gray area. And as physicians that are interested in physiatry or have matched into physiatry, nobody knows better than you guys. Most disabilities are not total. Maybe you'll find a trauma. That's going to probably be something that's total out of the gate, but most things are not. Most things start out, I'm not feeling so great. My hip is bothering me. My wrist is bothering me. Things get progressively worse. And I might have to limit what I do in a day. I might have to work fewer hours per day. Maybe I can't do everything I used to do. I have to do A, B, and C, but I used to do A, B, C, D, and E. So now I'm working fewer hours. I'm seeing fewer patients. Maybe I'm working fewer days, or a combination of all of these things. And I have a loss of income. And the threshold for loss of income where benefits become payable is typically going to be either 15%, 1-5, or 20% compared to your pre-disability income. So does own occupation help you if you have a loss of income, but you're doing your job? Not at all. You're doing your own occupation. Loss of income has nothing to do with the inability to do your job. So we add what's called the residual or partial benefit, which takes away the all or nothing and now introduces this income loss component. Now, typically built into the residual or partial rider is something called a recovery benefit. So let's say I was out of work for a year and I returned to my practice and they're like, oh, Dr. Keller, it's so nice to have you back. And I'm like, look, you have no idea. It's so great to be back. Like, I'm willing to work like a PGY1 again. Just dial me up and I will show up. I'll see as many patients as you want. My doctor says there's no limitations on me as far as time or as far as what I can do. Well, I can tell you, outside of residency or fellowship, a lot of the jobs that you see in hospitals or practices, they have a base salary. It might be a pretty good base salary, but a lot of them have an element of productivity or incentive pay. And we know the hospitals love to talk about money by not talking about money. We call this RVUs or WRVUs. So you go back to work, you're all excited. A lot of your patients said, well, doc, I needed your help and I didn't know you were ever going to come back. And I couldn't just sit and wait for you because I didn't know that this was going to be the case. I have found a new physiatrist. So you're going back to work, but you're just not as productive as you used to be. So you're not hitting those metrics you used to easily hit when you were at the top of your game. Physically, you're not sick. Financially, you still are. So if you are losing income, that same 15 or 20% compared to your pre-disability income, but now you can do everything you used to do for the same number of hours or more, and your prior disability is what's causing this loss, the recovery benefit will continue to pay you. And ideally, you want the recovery benefit to go the whole length of your policy to the age of 65 or longer. You have to be careful. Certain policies might have a limitation for this. One of the ones with a well-known insurance company, you couldn't buy it if you wanted to. It's built into the policy and it's got a 12-month limitation. So imagine if you're a private practice interventional pain management physician and you go back to work and your patient base has left you. It could take you a lot more than 12 months to get back to the point where you don't have a loss of income of 15 or 20%. Well, imagine if it takes you a lot longer and after 12 months, the insurance company says, doc, congratulations, you're working full time. You're doing everything you used to do for the same number of hours. We understand you're still losing money. We understand it was tied to your prior disability, but that's not our fault. And now the checks stop. So ideally, if you are paid based on productivity, or you think at some point in the future you might be, or you can't completely rule out that you won't be, ideally you want to have this unlimited recovery benefit. And again, it's typically built into the residual or partial rider. So most of the time you're not paying anything extra for it. One company in California, it's Principal, they make it available as an option. Specifically in California, the longest option that they provide is 3 years. So just know that that's in there. Then we've got our inflation adjustment, nothing too sexy here. They call this a cost of living adjustment rider or a COLA rider. This will increase your benefit after disability has lasted for a year. A good rule of thumb is the younger you are in your career, the more time you have as far as income potential, the less you have in terms of assets and the more you have in terms of debt, the more important the cost of living adjustment rider is. Of course, if money is an issue and I'm looking to cut down on my costs somewhere, and I don't expect to increase my coverage in the very near future, this might be the first thing to remove to simply buy a larger benefit or as close to the maximum that you qualify for based on either your income or based on your career stage, whether it's residency, fellowship, or what I'll deem to be new in practice, which is the last 6 months of training, depending upon the company, up to the first or second year of practicing. And last but not least here is the main reason that you're buying insurance when you're young is not only that you're young, but you're healthy. As time goes on, maybe you don't get the pat on the back from your physician anymore, and you've developed some medical condition. Clearly, you're not dead, you're not disabled, but you've got stuff that bothers you. I'll give you a very common one. Disc herniation at L5, S1. Well, the insurance company, if you did not have a policy already prior to this diagnosis with an increase option, If you're trying to buy new coverage, the insurance company is going to ask medical questions. And you would say, yes, I've got a disc herniation at L5S1. I had an MR. This is what it showed. And the insurance company would come back and say, doctor, we're very happy to insure you. But guess what we're not going to cover? We're not going to cover your spine, muscles, ligaments, or nerve roots, with the exception of laceration or fracture. And you'd probably say, Larry, are you kidding me? Like, I spend half my day hunched over, dealing with patients. I can easily see that a musculoskeletal problem disables me and prevents me from doing my job duties. And you're telling me the insurance company is not going to pay that type of claim unless it's a laceration or a fracture? And the answer is yes, that's exactly what I'm telling you. So you almost have to buy this before you know you need it. Because once you know you need it, if it's not a friend became disabled or a family member that had an issue and you learned it firsthand, by the time you realize you need it, very often it's too late to a certain extent. Does that make sense? So here's our true own occupation again. And it should say this, you'll be deemed totally disabled if you're unable to perform the material and substantial duties of your occupation. Well, what's a material and substantial duty? It's something that cannot be reasonably omitted from your job and allow you to really still work in that profession. So let's say you're an interventional pain management physician and you're doing nerve blocks and spinal cord stimulators, and you can no longer do that. Well, can you really work as an interventional pain management physician if you can't do interventions? I would say no, and you would be deemed totally disabled. And if you're deemed totally disabled from your regular occupation, that of an interventional pain management physician, and you choose to work in another occupation, like I said earlier, full benefits are payable regardless of the income that you earn in another occupation, or even if you retrain in another specialty or go into something completely unrelated. So here's your 6 companies that you really want to narrow down to. If someone is presenting an option and it's not one of these 6 companies, a bell has to go off in your head and you have to say, is this something I really should be considering? So you've got Berkshire. You can use Berkshire and Guardian interchangeably. Just know that Berkshire is not Berkshire Hathaway, and this has nothing to do with that company. You've got Standard Insurance Company, you've got Mass Mutual, you've got Principal, you've got Emeritus, and you've got Ohio National. So they are known as the Big 6. And Ohio National is not licensed to do business in New York. So really you're down to the 5 companies if you happen to be, living and working in the state of New York. So here's my 1, 2, 3. So when I created this, I said, physicians are really busy people. They're really smart. If you give them a roadmap, they are researchers by nature. And if they're interested, they'll make the time to do their research. If they have no interest, they really have no time. So if I'm going to narrow down, these are the 3 things that are right away going to point me in the right direction, assuming I've already got the first piece of the puzzle met, that I know I'm looking at companies that offer own occupation coverage in its true sense. So other than price, because everyone knows price, we can look at a number and know whether one is more expensive than another, but how are claims handled for mental and nervous conditions? How are claims handled if you're disabled and you choose to reside overseas? And then there's 2 different types of increase option. You should know which one you prefer in your policy. And some only come one way, and some give you a choice. So when I say mental and nervous and substance abuse disorders, I can all but guarantee you, I think like an insurance agent. I do not think like a physician. So physiatrists are thinking mental and nervous. I don't know, what does that mean? Like, is that including like Parkinson's? I don't want to buy a policy that's going to rule that out. Or what about MS? So when I say mental nervous conditions, I am talking about anxiety, depression, stress, chemical dependency, drug addiction, PTSD. If the primary cause of a claim is one of those things, most of the insurance companies will provide a limitation for those types of claims. And it's typically going to be either 24 months over your lifetime, or it's going to be 24 months per episode of disability. And a new episode is typically separated by more than a year. So if I was disabled for depression and I was out on a claim for 2 years, exactly 2 years, I recover, I go back to work for 18 months, and now I'm disabled again, I've kind of relapsed. If my company that had my policy uses episode rather than lifetime, I would have another 24 months available to me. If my company had a lifetime limitation, I've already used my 24 months and I'm not going to get paid anymore. Now, a really important thing to know is even if you have a policy that has a limitation, this does not apply for dementia as a result of a stroke, a trauma, head injury, viral infection, MS, Parkinson's. I've got a physical condition that prevents me from working as a physiatrist. And secondary to that, I'm completely depressed. Well, that's incidental or secondary to the fact that you're suffering a physical disability that's preventing you from doing your job. And if you also had a physical condition, in addition to a psychiatric condition, well, again, that mental nervous condition, would not be looked at if the primary cause of your disability was physical. An important thing to note here is if you plan on going into interventional pain management and you are going to do a pain management fellowship, any policy that you buy from any company is going to mandate that you have a limitation for these types of claims. If you buy your policy as a physiatrist, even if I'm going to be doing a fellowship, all I want to be when I grow up is an interventional pain management physician, and you buy a policy with no limitation as a physiatrist, and you subsequently do an interventional pain management fellowship, you can have unlimited mental nervous coverage. So some companies give you a choice. Some companies only have a limitation. Just know what's important to you and what's not. If you're the type that says, if I haven't melted down yet, I got to tell you, it's not going to happen. I'm not willing to pay extra to have an unlimited benefit. So be it. Go with the limitation. If you look at it and say, I'm buying it for the unknown, I just don't know what's going to happen. There's a 10% difference to have unlimited coverage as opposed to limited, and more liberal coverage is more important than the cost savings, then I would recommend go with unlimited. Ideally, a policy that covers more things rather than less things with fewer limitations is better than one that has more limitations. Does that make sense? Hey, big one here. So let's say you're a visa holder. You're in medical school, you're getting ready to finish up, you're on a J1 visa or you're on an H1B, and God forbid you're disabled. And as a result of your disability, you lose your visa and you have to return to your country of citizenship. I can tell you, with the exception of Berkshire Life, which is Guardian, nobody else is going to pay you as a visa holder on an unlimited basis. Most companies are either not going to pay you at all, or they're going to limit your ability to receive benefits overseas as a visa holder to 12 months. So unless you're in California, Delaware, Florida, Montana, North Dakota, New York, South Dakota, or Wyoming, if you're anywhere but those and you buy a Guardian policy, they're going to put on what they call a foreign travel exclusion rider. But it's really not an exclusion rider. Essentially, it says if your disability starts in the United States, and now let's say you lose your visa, your sponsorship is over, and you need to return to your country of origin, but your disability started in the United States, you can continue to receive benefits overseas with no limitation at all. The same thing is true if you happen to be visiting family and you were outside of the United States, but you had tickets booked to return within 31 days. So we'll just call this incidental travel. And now you're disabled and you can't even make it back to the United States. Again, you can continue to receive benefits overseas with no limitation. Now, I'm generally a pretty simple guy and I'm very conceptual. But if I am a visa holder And I know if I become disabled, I'm going to lose my visa. And I have the ability to buy a policy that's going to continue to pay me overseas versus one that's not. I got to tell you, 100% of the time, I'm going with the one that's going to continue to pay me overseas. I don't know why someone would not do that. Well, actually, I take that back. They got a spreadsheet. This was not important to the agent that created the spreadsheet. You guys didn't know to ask. Had you known, of course, you'd buy a policy that would continue to pay you if you lost your visa. But no, you elected one that didn't because you didn't get a chance to vote. So hopefully that makes sense. Then you've got your increase options. So you've got two types of increase options. The first one is what's known as the future increase option rider. And in the financial services world, we love acronyms as much as medicine, maybe even more. So we just call this the FIO. And the FIO says, you're going to pay us, the insurance company, for the ability to buy more coverage in the future and the right to do that regardless of your health. Now, typically, the amount of the FIO rider is a function of your starting benefit level. So a negative is if you're buying a really small policy, your increase option is probably going to be really small too. But this option comes up every year. It's like your birthday. If you want to use it, that's great. If you don't want to use it, you don't have to. If you say, look, I know I'm earning more money or I've moved up in the society as far as my training goes, I know I qualify for more insurance, but I just don't want to spend any more money. That's okay. You can choose to not do anything, no harm, no foul. Some companies are going to give you a new policy when you exercise your increase option. Others are just going to amend what you already own. And I can tell you, one that's going to amend that policy that you already own, that gives you more guarantees than one that's not going to do that. That says, hey, we're going to give you a new policy for the new coverage based on whatever it is that we're doing at the time that you buy more, not only in terms of the price, but in terms of the contract language. So it just leaves more room for question marks. This is a relatively new rider. So this one, just call it a B rider: benefit purchase, benefit update, benefit increase. So benefit purchase, we call it BPR, benefit update, BU, benefit increase rider, BIR. And it's the same right to buy more coverage in the future, regardless of your health. But if it is included, this is a no-cost rider. So you could potentially buy a really small policy with a really big increase option. We'll talk about that. I have a strategy for this. But because you're getting something at no cost, the insurance company says, we're the insurance company. We're smart. After we do your initial exam, blood test, urine test, if required, and we ask you medical questions, we know you're going to know more about your health going forward than we are. And if you know that you're the individual that's got the disc herniation at L5-S1, and you're terrified that your career could come to a crashing end, you probably want to buy as much as you can, as soon as you can. Well, if you do that, we'll call you the unhealthy guy, and could easily be a girl too. And the healthy person says, I don't want to spend any more money on insurance. The technical term, we call this adverse selection. The healthy person does nothing. The sick person wants to buy as much as they can. And now the insurance company gets smoked on a provision that they did not charge for. So the rub is you have to check in with the insurance company every 3 years. And we're going to ask you, who are you? Where do you work? What do you do? What have you earned so far this year? What did you earn last year? Well, if you don't qualify for any more coverage, you don't have to do anything. You're essentially checking in to be turned down to preserve your increase option. But if you do qualify for more and the insurance company gives you an amount, you have to buy at least half of what they offer. If you don't check in or you don't buy at least half of what they offer, you're going to lose your increase option. So that can potentially be a negative if you're not great administratively, or you're not going to keep up with your coverage relative to what your income is if you qualify. So here's my quick increase option summary. We said some companies will give you new policies, other will amend your existing coverage. If you don't mind checking in every 3 years, and you're probably going to want to increase your coverage anyway, especially early in your career, any of those B riders could be a great option to lock in, especially since you're not paying like you would be for the FIO rider. That can even make it more affordable. But in the majority of cases, the occupation class, so this is just an element of disability insurance pricing, is not protected by the B increases. So if you bought your policy as a physiatrist, the category of a physiatrist is more favorable. It's less expensive in terms of the cost than an interventional pain management physician. So if you plan on doing pain management and the occupation class is not guaranteed for future increases, just know you're setting yourself up to pay a higher premium for that additional coverage once you start your fellowship and beyond. If you have one of the other ones that starts with an F, you're locking into the category of risk that you got when you were a physiatrist, which is going to be more favorable. So if you like more flexibility, like I want to be my own person, I'm not checking in, I'm not playing by the insurance company's rules, then the FIO rider is likely for you. If you look at it and say, you know what, I don't care, I'm going to check in, I want to buy as much as I can, as young as I can, my entire financial future is based on my ability to do my job, I can always reduce my coverage later, then any of the B options might be really good. So here's a great example. This is not my recommendation, by the way, but it can work really, really well. So let's say you're a PGY1 or you're a medical student and you're like, I'm kind of a believer. Like I've seen enough bad stuff. I think I should have disability insurance academically, but my wallet doesn't allow for it. I just don't want to spend money on disability insurance. Like if there is a way I could pay as little as possible, lock into the fact that my health is good today, and literally do nothing throughout my training, and then put my pedal to the metal and never have to answer another medical question again, that I would like to do. So the lease with the option to buy strategy works for a B rider. So this would work with Principal, this would work with Standard Insurance Company, and you literally buy like $1,000 a month benefit. So for a male, this might be $25. For a female, it might be $50 monthly. Now you have it locked in. You wait until you're finishing your training. Now you can increase it from say $1,000 a month up to as much as $20,000 or even $30,000. So it's kind of like an accordion. It fits today. I don't have any money. I don't have a lot of time, but my health is good. A lot of people forget their money is what pays the premium, but their health is actually what buys them the insurance. This solves the problem with the lack of money, with the fact that I'm still in good health. So definitely something to consider. But again, if you can afford more, buy more. This is a great way to circumvent and really take advantage of a tight cash flow and put the insurance company potentially on the hook, regardless of your health in the future. California. If anybody's going to California and you're not there now, buy your policy before you leave. California is the most expensive state. You're going to have the most limited policy choices. Policies are generally less liberal. So if you buy before you go to California, you can take advantage of better contractual provisions and lower pricing. But again, be careful, because if they give you a new policy when you leave and the additional coverage takes the California policy form, you got a result, but you didn't get the ideal result. Now, some people that are listening to this might have medical issues, and they might be something that medically is managed well. Like, I'm not really concerned. I can go about my day. My job duties are not going to be a problem. But from the insurance companies, this is like a dark cloud, and I'm never going to qualify for insurance. And a really easy one is juvenile diabetes. Like, you are really uninsurable when it comes to the traditional insurance companies. So certain residency programs will have what's called a guaranteed standard issue plan. Remember, I said we love acronyms in insurance, GSI. And there's virtually no medical questions on the application. There's no exam, blood tests, urine tests. The only caveat is if you applied for insurance previously and you were declined for individual coverage, this might be off the table. But most applicants are going to get coverage even if there's adverse medical history. I use my juvenile diabetic as an example. They're probably taking insulin. If they took insulin within 90 days prior to buying the insurance, and they become disabled within a year as a result of diabetic complications, that's not going to be covered. But after they own the policy for a year, even pre-existing conditions are covered. So this can be literally like the brass ring at the carnival that you grab for. So one reason is you've got health that's problematic for underwriting. The other one is if you're female and you've ever looked at this, the rates for females are much more expensive than they are for men. And it really comes down to pregnancy and complications, higher rate of autoimmune disorders, believe it or not, higher rate of mental/nervous and substance abuse disorders. But a lot of these plans have gender neutral or unisex rates. And we'll see, this can save you like 40 to 50% off of the cost of your insurance. So where do you find unisex rates? The bottom point, we said some guaranteed standard issue plans have them. The Commonwealth of Massachusetts passed a bill about 2 years ago. It was H482. And it basically says insurance companies cannot discriminate based upon many things. One of them is gender. So currently, if you're in the Commonwealth of Massachusetts for school, or you're going there for residency, and you're going to leave, buy your policy with unisex rates if you can. So Emeritus, Principal, and Ohio National currently offer unisex rates in Massachusetts. Berkshire, which is Guardian, Standard Insurance Company, and Mass Mutual currently do not. So if I'm a conceptual guy, if I'm female, I'm going Emeritus, Principal, and Ohio National. And if I'm a guy, I'm going Berkshire, Standard, and Mass Mutual. But again, I would look at them all to see what the rates look like and see what the benefits look like. If you wind up in Ohio, or you're in Ohio, anytime that you're getting a discount on an Emeritus policy, that's an insurance company, it's always unisex. So if you're in Ohio now, or you're going to Ohio and you can't get unisex rates elsewhere, take advantage when you get to Ohio. If you leave, you're still going to have those unisex rates, not only for what you start with, but anything you ever add. I don't have too many of these, but all policies in Montana have unisex rates. Massachusetts kind of followed what Montana did. Here's an example of the savings. So I just did a $5,000 benefit. I used Principal Insurance Company. I used the occupational class of a physiatrist. For the rates for both males and females, I happen to use Rhode Island and their gender distinct rates. And then for unisex rates, I used the Commonwealth of Massachusetts and a multi-life discount. So let's just take a 30-year-old male, $111 a month. Their policy is pretty much loaded with what I described. Look at our female number, $178 a month. That's a big, big difference. But our unisex rate is $128.86. So it kind of goes to what I said before. If I'm a female, I would much rather pay $128 from now until my 65th birthday than $178. If I'm a guy, I'd really rather pay $111 than $128. So look at the options, try to get the best deal in terms of payment, and then also try to find what meets your individual needs, goals, and budget. Let's just take a quick minute to talk about life insurance. So life insurance, the most common type, and really the one that you should own if you're a resident or a fellow or a new attending, is term life insurance. It's very easy. It's death benefit only. You can buy the largest amount of coverage for the lowest premium. Ideally, you want to buy a policy with a fixed premium rate. And they typically come 5 years, 10 years, 15 years, 20 years, 25 years, 30 years, 35 years, believe it or not, even 40 years. One company says, oh, you can choose what you want from 16 to 29 years in 1 year increments. So if your heart desired an 18-year level term, you can do that. It's kind of like, Goldilocks. Oh, 15 years is too short, 20 years is too long, 18 years is just right. You can do that. And the company that has that is American General or US Life in New York State. Consider laddering your coverage to better meet your goals. Well, laddering is just a fancy term for getting multiple policies with different durations that have a level cost. So if I wanted to be really conservative, and let's just say I wanted $3 million of death benefit, clearly that's high for a resident or a fellow, unless they're ready to graduate. If I wanted 3 million, I could go out and buy a 30-year level term. And let's just say I was 30 years old. This will get me up until the age of 60. And I lock it up and I throw away the key. But, as a physician, am I really going to need all of my coverage for 30 years? I would like to think no. I'm going to pay down my debt. I'm going to save for my children's college education. I'm going to pay down my mortgage. I'm going to save for retirement. And the truth of the matter is, if I'm doing it right as time marches on, my need for the same amount of life insurance is actually going down. So instead of buying 3 million for 30 years, I might buy 2 million with a fixed rate for 20 years and 1 million with a fixed rate for 30 years. Something happens to me in the first 20 years, everything pays. The 2 million of 20 pays and the 1 million of 30 pays. If my spouse doesn't kill me and my kids don't kill me and I make it 20 years, the first 2 million goes away and I've got 1 million left on the back end. Well, not only did the death benefit for the first 2 million go away, so did the cost of that. So when do you need more life insurance? Generally, you need the most when you have the least. And as you have more, your needs actually go down. So this laddering concept really can work well with one's financial planning. Now, term life insurance really doesn't differ much from one company to another. The premiums are based on your height and weight, your personal history, your family history of cardiovascular disorders or cancer. And when I say cardiovascular, it's really going to be coronary artery disease. Some companies use a death criteria. So if you had a father that passed away of an MI under the age of 60, that might impact you. But other companies might say, if they didn't pass away and it was just a diagnosis, we'll still give you the best category. So again, do your homework. Typically, medical students, residents, and fellows really should only purchase this type of life insurance. Life insurance is not an investment. It's not for you. It's not the panacea of financial vehicles. It's really something happens to me. I need to leave money to my survivors and those that depend upon my income. So here's a couple of podcasts that I did and a few guest posts that I did. You should be able to highlight them and just paste them into a browser and you'll get an idea. The one on the bottom, it's called The Cost of Waiting for Disability Insurance. And I give an example of, even if you paid the premium for X number of years, what's your break-even point if you went on claim? I did one for the prudent plastic surgeon talking about, what if you have medical issues? And it talks a little bit more about those guaranteed standard issue plans. Surprise, surprise, how I came up with my topic is I did one for White Coat Investor called Finding the Right Disability Insurance Policy is as easy as 1, 2, 3. So that'll be a really good review of what I talked about. And then I did a relatively long one just on long-term disability insurance with a fee-only financial advisor. And that's the top one. So what do you need to know? And then we're going to open this up to some questions and I'll answer the ones that I've gotten so far. The truth of the matter is you have worked really hard to get to where you are. If you're MS3 or better yet, MS4, you've been in a marathon for the last X number of years of your life. And you could see the finish line. And God forbid, if you fall right before you cross the finish line, that would be becoming too sick or hurt before you get a chance to utilize your education, training, experience to pay down your debt and really accumulate a lifestyle for yourself and your family. Like I said, every individual is different. Insurance is not one size fits all. The spreadsheet concept is designed to lead you down to a path as if everyone's the same. And like I said, if you wanted unlimited mental nervous coverage, but that wasn't presented to you and you didn't know to ask, you might buy a policy with a limitation unknowingly, where if you knew, you would never have considered that. And unfortunately, you guys see this in your specialty or your intended specialty. Not everything in life is in our control. Be prepared. Don't leave it to luck. So if you've got questions or comments, I'm happy to answer them. I'm going to go with the ones that I've got so far. I'll try to figure out the chat function, or you guys can read it to me and I'll answer what I can. If you want to email me, my email address is there. If you want to call, you're more than welcome to call. I would say view me as a resource. Don't view me as like, oh, I'm going to call this guy and he's going to try to sell me stuff. No, thankfully, I can tell you, I've been in the industry 31 years. In my heart of hearts, I still think I look like a resident, but when I look in the mirror, I don't quite see that. But in the beginning, when you're new, it's kind of like everyone's a hand surgeon, right? Anything you can get your hands on. And then after a while, you figure out, this is what I'm good at. This is what I like to do. I'm going to stay into my own lane. And it's really not about getting someone to become a client instantly or trying to get them to do something that they shouldn't be doing. It's really about paying it forward and helping someone achieve what it is that they want to achieve. So I will open it up to questions. I'm going to pull up the ones that I've gotten so far. So let's go with yours first. Questions jumping out on anybody. Hopefully you found this, at least you knew more than you did before we started. That's my hope.
I actually do have a few questions if you don't mind.
Fire away. That's what
First of all, thank you so much for doing this talk. I knew I knew nothing about insurance, but I realized I knew even less than I thought I did. So thank you.
Do not worry. Insurance.
And now I know more though.
Yeah, insurance is just legalized gambling. And I wear a suit instead of a fedora, and like a purple coat.
Yeah.
It's like Monopoly. You just want to know the rules of the game and you want to move your pieces along. And financial planning is no different. So let's go with the first question that you guys have.
So do you typically recommend that residents look at the policies that their residency is going to give them for disability insurance and then buy one based off of what the residency gives you, or just kind of base it off what you need in your life without the residency's disability insurance they're going to give you?
Yeah, I mean, know what the residency program is going to give you, but because the individual companies are going to ignore it anyway, and we're going to say you're automatically eligible for $5,000 a month or $6,000 a month. And if you look at it, $5,000 a month is $60,000 a year tax-free. That's a lot more than residents or fellows are bringing home, even in their chief year. So we don't care. So I would start with what's the most that I can buy based on my stage of career. And then I would say, well, you know what, if I can't afford this or I don't want to afford this, what can I do to better fit this to meet my individual needs, goals, and budget? Now, it could be, if we're using one of the B options, it could even be my income is X, my employer is providing me with this coverage. I really just want to fill in a gap between the two. I'm not looking to knock it out of the park. I'm really looking to jam my foot in the door, and I will really revisit this as my career progresses and as my income is rising. Maybe I'm doing a little bit of moonlighting, but I think it's really important to do it early. Like, some people have come to me and they say, now that I'm board certified, I feel like I'm worth something. And I'm like, I got news for you. You might have not been worth all that much financially before, but look at everything that you spent. Look at all the time you spent. Like, I can tell you, most people, when it comes to financial advisors or insurance agents, I can't tell you I woke up and I said, I can't wait to be an insurance agent. No, it never happens. Most people that are insurance agents, it's either accident, or they knew someone that had a pretty good business, it was growing, and much like an attorney might bring in an associate, we bring somebody else in. Physicians don't work like this. Physicians, most of you could probably say, I knew at the age of 3, I wanted to be a physician. And I knew physiatry is what I wanted to do because I saw, the softball player that I loved get hurt and get rehabilitated due to the physiatrist. And a lot of people, medical specialty really is based on personal experience. If not their own, it's going to be based on, a friend or a family member. So you see that a lot. Does that make sense?
Yeah, definitely. Thank you.
No problem.
And then the other question I had too is, do you recommend getting disability insurance before residency starts, or waiting until you start getting the income from that?
You could go either way. I mean, right now you're all close enough that we're willing to give you the resident limits. We're willing to give you discounts either from your medical school or based on where you're going, because you all pretty much know where you're going to go if you've matched. Now, one thing which is interesting is if you're an MS3 and you know you want to go into physiatry, but you haven't matched yet, the insurance companies got smart a couple of years ago. So I will tell you, the game that we used to play as agents, person is a medical student. What is their specialty? I don't know, they haven't matched. And it used to be, oh, well, if you didn't match, we're going to assume you're going into a favorable specialty or a non-surgical specialty. Now we go the opposite way. And we say, oh, well, if you didn't match and you don't know what you're doing, we're going to assume you're going into something like emergency medicine or anesthesia. And once you prove otherwise, if you bought your policy early, we can upgrade your category and reduce your cost, but you can't beat it. Another game, I will tell you, I didn't play this one, but I know some friends that did, is, oh, I'm going into anesthesia. I'm going to be a transitional year resident. But they wouldn't tell the insurance company they're doing a transitional year. They would say, I'm an internal medicine resident. And I say, you're not an internal medicine resident. If I go on and I Google match list Tulane University Medical School, I can easily see that you matched into anesthesia. And now if you become disabled and it's within the first 2 years of owning the policy, the insurance company could say, you didn't represent this correctly. You told us you were an internal medicine resident. Had we known you were an anesthesia resident, we would have charged you this. Because you paid this, we're either going to look to rescind your policy altogether. Here's all your money back from day one plus interest. It was nice knowing you. Or we're going to cut down the benefits based on what your premium would have bought had we known you were an anesthesiologist. So, but I always say sooner rather than later, just because the same way you guys have all the nightmare stories, I have them too. Like in the world of disability insurance, there is some phenomenon out there that makes a really smart physician somehow forget a lot of stuff. So here's a perfect example. I had this one the other day. Hi, Larry, I heard you're really good with disability insurance. Can you help me? And I said, I'd like to think that I'm good, but sure, tell me what you got. Oh, I'm an internal medicine physician. I've got some ringing in the ears. I'm under the care of an otolaryngologist, but I don't have a differential diagnosis. I'm thinking I could buy my disability insurance policy before I get that. And I said, you are thinking very wrong. Do you know what it takes to file a disability insurance claim? And of course he didn't know. Why would he know? So I said, I know you don't know. Let me tell you. You need to have the inability to do one or more of the material and substantial duties of your occupation. Do you use the stethoscope as an internal medicine physician? Yes. How often do you use your stethoscope? Daily. Let me ask you, are you having problems using the stethoscope or doing a patient history and physical when you're having this stuff go on? He goes, well, yeah, I'm trying to read a little bit of lips and it's not great. And I said, okay, so we know you've got 1 foot towards the claim. Number 2 is you need to be under the care of a physician. All right, you told me you're under the care of a physician, right? He goes, oh yeah. And I said, number 3 is you have to have a loss of income. Do you have that yet? He goes, no, I don't have that yet. That's why I was hoping to buy the policy before I got the diagnosis. And I said, no, it's kind of like the horses have already left the barn. You needed to do this before any of this stuff happened. So like I said, I don't know, maybe I'll call it willful negligence, because I think he's a smart guy. He probably just said, you know what, if I can get something and I can benefit myself, I would love to do it after the fact. Human beings are somewhat selfish. I completely get that. But, then the reality sets in. So next question.
That's all I have for now. I know someone else has one, but thank you again. That was amazing.
No, thank you so much. And if you guys think of anything, or you're looking for other speakers in other areas, I'm happy to, plug people in that I know that are really good people. I'll make a plug. It's not a shameless plug because I have nothing to do with it. But if any of your friends out there are first-year medical students, White Coat Investor, Jim Dolly has something that is called like his Champions program. And if you're a first-year medical student and you go to his website and you become like the champion for your class, They give you a box of free books for everyone in your class on the White Coat Investor Student Guide. Then they give you, as the championship person, a nice Yeti mug and a t-shirt just for taking a picture with the whole class with the books. So if they haven't done that, they should do that. It's great and it's free. So no complaints there.
That's wonderful. I have a quick question for you. Do you still have time?
Absolutely. I'm going nowhere.
Awesome. So you kind of started to talk about this, but I guess I'll ask more specifically. So there is a chunk of PM&R residents who match into advanced programs. So programs that require that transitional year, like you had said, or that prelim year.
Yes.
Often this is done in a separate state. So in my situation, I matched into my transitional year in New Mexico, and then I'll be headed to Miami, Florida for my PM&R advanced program. So I guess this got me thinking too, when you started talking about it and you talked about different disability insurances for state and versus the ones that your residency program offers. What is that going to look like for me when I'm making those decisions and for other students in my similar position with physiatry? Do we have to worry about different loopholes with being in different states or different residency programs?
It kind of depends. So I can tell you Florida is like California. It's not as bad. So California hands down is the worst. Every policy written in the state of California, physician or otherwise, has to have a mental nervous substance abuse disorder limitation. I guess people would rather be on the beach than in the clinic or operating room or doing procedures. So Florida happens to be a state that most of the insurance companies have a load. So it just means they're charging you more money. So it happens to be that Standard Insurance Company and Principal do not have a load in Florida. They're priced the same as everywhere else. Now, are you going to University of New Mexico by any chance for transitional year?
No.
Okay, so if you were going there, or you might be going to another place. So for example, University of New Mexico has a guaranteed standard issue plan with emeritus. So let's say you had a medical condition, very common one, anxiety, depression, ADD, ADHD. I would say 4 or 5 physicians out of every 10 that are residents or fellows are taking something or they're in therapy. Normally that's going to cause an exclusion for claims related to mental and nervous conditions. So we'll just make it up. You're not going there, but let's say you will go into a hospital that had a GSI plan. Well, not only could you get unisex rates, but even if you were, on sertraline or bupropion and in therapy, and you bought this policy, after 12 months, even claims related to mental or nervous conditions would be covered for 24 months, as opposed to 0. So I would say it's 2 things. One is, what are the options available at the institution that I'm doing my transitional year in? That might open up some extra doors. And then the other one might even be, if you know where you're going, which you do, what's available in my real institution where I'm going to be doing PM&R. And it's always trying to take advantage of the best option. So if you said, hey, my transitional year is going to be in New Mexico, and then I'm going to Florida, I could tell you without looking, for the most part, New Mexico rates are going to be better than Florida rates for the majority of the insurance companies. So even if you did something like a lease with an option to buy plan that guaranteed the original state that you bought your policy in, so let's say Standard Insurance Company, if you buy a policy in New Mexico and you go to Florida, you're always going to carry your original state of New Mexico. So if that's better, no problem, you take it with you. Mm-hmm. Guardian, on the other hand, says, oh, you think you're so smart? Sure you are, but we're smarter. You bought in New Mexico. Now, if you go to Florida, anything you buy in Florida is going to be a Florida policy with Florida premium rates. Again, a result, ideal result? No. So a lot of it is just running stuff by someone like me or someone that's experienced to be able to give you guidance and say, okay, I'm not going to tell you not to buy anything if you really want to be covered, but if there's a better option for you and it's a couple of months away, you might just want to wait. So a great example is someone that's in California now, they can't get unisex rates or a discount, they're healthy, and they're leaving California. Then they can either buy like a lease with an option to buy plan, and if they stay healthy, replace that with a new policy from the state that they're going. And then if they fall to pieces after they bought it, at least they're still protected from the health standpoint, short of actually becoming disabled. So a lot of it is really just mapping out, okay, what's this person's, career progression? Where can they get the best value for their dollar? Because the one thing that we don't know is health. And I'll use like a great Jim Dolly quote, my crystal ball is cloudy. If I knew no one ever needed to buy it, I would never sell it. But if I knew that they needed it, that would be a great thing. So another good story. And again, I always find the stories are good because you'll forget all the terminology, but you'll remember the stories. So I had someone, she had cancer years ago, and she applied medically. There was no guaranteed standard issue plan at the hospital. And they came back and they said, we're going to pay her for 5 years. We are going to charge her 50% extra. So they call that a rating. It's like a substandard additional premium charge. No increase options. And she had infertility problems and PCOS, so we're not going to cover complications of pregnancy. Now, is that a good offer? For her, it was a good offer. Is it ideal? No. Well, from the time I put in her application, I found out that a guaranteed standard issue plan was started at her hospital. And she had already left, but it was available for up to 90 days after she left. And, she had cancer. She had a lot of stuff. They didn't even get all her medical records yet. And they already said this is what they were going to do. So I called her up and I said, today is your lucky day. And she laughed. She goes, because I'm talking to you? I'm like, I don't know. Some might say it's your unlucky day. I go, but today is your lucky day because I found you a guaranteed standard issue plan. And all the stuff that I told you that you weren't going to be able to get, you're going to be able to get, and it's going to be discounted. The only thing I can't do is I can't be the guy that does it for you. It's an exclusive offering. And I'm going to make an introduction so you can go buy that policy because that's what you should do. It's not about me. It's about you. So I won't get on a tangent, but there is something that's called a fiduciary. And a fiduciary basically says, like, I have to work in your best interest. And because I'm a certified financial planner, the CFP board, think of it like the boards of the world of financial planning, even though the fiduciary rule that says I have to act in your best interest doesn't exist. It exists within that board. And they say, if you're holding yourself out as a CFP, you have to adhere to this. So it's like when you guys get up and you're like, I'm ready to make my talk. By the way, here are all the disclosures I have. It's kind of very similar to this, but insurance companies and brokers that sell investments are not fiduciaries. They just have to meet what's called a suitability standard, which means unless I'm blatantly doing something that's not in your best interest, if I put you in a better position, it doesn't have to be a great result. I'm okay. So if you're looking for a financial advisor, I would strongly suggest a fiduciary. Ideally, it's someone that doesn't sell products that's your financial advisor because they really have an immediate built-in conflict of interest. Do I sell products or do I give advice? And can you really do both in a great way? Not really. So I kind of say financial planners are all good and they're all compensated in different ways. Understand how they're compensated. And as long as you're getting what you deem to be good advice at a fair price, that's great. But ideally, I say the insurance guy should be the product person and the financial planner should be somebody else, unless the recommendations that they're making is incidental to what they're doing and they're not being compensated as a result of the advice that they're giving. So like I might talk to someone about student loans. I'm not charging them. I don't get compensated for it. If they take my advice, that's great. If they don't, that's okay too. It's really more just like in passing. But ideally, they should be talking to a student loan expert because this stuff changes pretty quickly. Does that make sense? Perfect. Next question out there. All right, so I'm going to go with the ones that I got from you guys. So the first one is waiting until your final year of residency too late to lock in low interest rates for disability? Well, it's really low rates, not interest rates. But no, it's not too late. But if you're towards the end of your residency and you know you're doing an interventional pain management fellowship, and one of the questions on the application is, are you going to be changing jobs or occupations within the next 6 or 12 months? And now you're telling them, oh yes, I'm going to be doing interventional pain management at wherever. They're not going to look at you as a physiatrist anymore. They're going to look at you as an interventional pain management physician. The cost of your policy is going to be higher. And remember, you're going to have that mandatory 24-month limitation for those types of claims, even if you're not going to a state that requires it. So I would say, if at all costs you can avoid doing that, I would avoid doing that. I would go so far as to say your first purchase in training should be disability insurance. Better than a Roth IRA, better than paying down your debt, because this is what's going to give you the income if you fall before the finish line. And it doesn't mean you go out and buy the most expensive thing in the world, but lay the foundation before you look to put the roof on. Can an insurance policy be paid by the company the physician works for, or is this not common? Well, a group insurance plan usually is paid for by the company you work for because they're giving it to you for free. As a result of that, generally, if you become disabled and the hospital took the income tax deduction, your benefits will be taxable. So another reason to potentially buy an individual plan is to fill in the taxes you would lose on what your employer provides, and then have your individual policy so it's portable when you finish your training. But typically on an individual policy, it's going to be you paying for it on your own. It's not income tax deductible. I won't bore you with details. You'd actually have to be a C corporation to be able to do it to get any benefit. But even if you could, and you deducted it, now your benefit is taxable. So again, I would look to avoid that. Just pay it personally and forget about it. How can one cope with debt in the medical profession? This is going to sound terrible. Make sure the specialty that you're going into affords you the ability to pay your debt down. So if I knew my love was pediatrics, and again, this even predates you guys because you're already finishing up, I would probably want to go to a better valued medical school than a more expensive private medical school if I can avoid it. At the end of the day, I can tell you how many of your patients truly are looking to see where you went to medical school or where you went to do your residency. I would say less than 5%, and that's probably being generous. I can also tell you it's not where you go to school. It's not even where you do your residency. It's what you add to the program and what you take out of it. So if you're diligent and you're willing to work, I would just try to go to the least expensive school that I could, get into the best residency program I could. And you guys know this. Oh, who wants to do this? Me. Oh, your schedule seems like it's already full. No, it's not. I could still do it. Always ask, for more, always be available, affable. That's the way to do it. I would also come up with we don't like the term budget, let's call it spending plan. I would like to know if my check is coming in, what am I allocating to which expenses do I have? If I know I'm going to be going for public service loan forgiveness. So for those of you that don't know, this is you're going to work for a 501c3 nonprofit organization. And after you've made 120 payments, essentially 10 years, your debt is forgiven on an income tax-free basis. I mean, talk about a Roth IRA. That's like the mega Roth IRA. So if I was looking to take a job and I knew I had a bunch of years already doing residency and fellowship, and I was torn between private practice with a higher salary or an academic institution with a lower salary, I got to tell you, there's a really good chance I'd be thinking about taking the lower paying job with the academic institution, delaying my gratification of going into private practice to get my loans forgiven. That it's really, really important. And you probably wouldn't be shocked as to how many people I talked to that they didn't even know that public service loan forgiveness was an option. And they're like a PGY 9. Think about that. They're 90% of the way there from getting their student loans forgiven. And it used to be, oh, well, it's not really going to happen anyway. Oh, it's happening. White Coat Investor has another podcast that's called Milestone to Millionaire. And he's had several people on there that have already received forgiveness. So if you like a short podcast that's not really financial, that's a great one to listen to also.
Mr. Keller,
Mhm.
there's another question in the chat quick from
Yep.
Jimmy who's listening. Are you able to answer that one?
Sure.
It's what are your recommendations for physician couples about getting disability insurance?
I get this one a lot. Now, the first thing I'll say is hopefully it doesn't happen. Couples get divorced. So there is this misconception that one physician that works and earns a physician income can actually be the other person's disability insurance policy. And we only need to insure one of us. No, I think you need to both have your own policy because you don't know what's going to happen. You will typically find if something happens to one spouse, the other well spouse is working less because they want to take care and be with the spouse that has the disability. So I would say you both need to be insured. You both want to maintain your individuality in the event something happens. Does it mean you need to both get the best of everything? No. If one spouse is an orthopedic surgeon and another spouse is a pediatrician, clearly you've got an income differential there. Maybe the income associated with the lesser spouse is not as important. So maybe I would leave off the cost of living adjustment rider. It's just not as important. Maybe I would extend the waiting period. Instead of waiting 3 months to get benefits, maybe I would make it 6 months. But I would certainly insure, both people just because you don't know what's going to happen. I've seen that, way too much. So long end and the short end is both you should be insured. If there's any discounts available, take advantage of them. Your best opportunity to get advantage as far as discounts go, or the most ability to find discounts on the most companies is going to be medical students, residents, and fellows. Once you're out in practice, 100% of the time you could find a discount on at least one of the companies, but it's much less likely that it's going to be all of the companies. Does that make sense?
Yeah, that was great. Thank you, Mr. Keller.
Oh, you're very, very welcome. Here's our next one is, how do we find residencies that have a 401k? Is it okay to ask the program director? I would say almost all of them are going to have a 401k. It's likely going to be what's called a 403b, which is a tax sheltered annuity in a nonprofit. And I think it's okay to ask. I got news for you. The program director probably doesn't even know. I would say you're better off asking human resources, or when you're interviewing, they might give you like an orientation packet that talks about what they make available. You'll find it in there. I can all but guarantee you're not going to get a match. So a match is you put away $1, we give you, say, 50 cents. If they have a match, you really want to take advantage because that's free money. But odds are very good for residents, there won't be a match. So you're going to put away your money. It's going to grow tax deferred. It's going to be creditor protected. It's certainly a good thing to do. If you're not going for public service loan forgiveness, or you're not using income-driven repayment, because if you're using income-driven repayment or you're going for PSLF, you want your payments to be as low as possible so you get as much forgiven, or you want your payments to be as low as possible. So the general rule is if I can put money away on a pre-tax basis and lower my income, that's good if you're going for PSLF or you're going for income-driven repayment. It's not good if you know you're not doing that and you know that your income tax bracket and your income are low today, and you're going to be in a higher bracket later as an attending physician, then you probably want to do what's called the Roth IRA or the Roth 403b. I won't bore you with the details, but you're putting away after-tax money today, ideally when your bracket is low, and when you take the money out later plus any gains, there's no taxes. So if you are a resident or a fellow or a medical student, you're like, I have like no income, but I'm starting to earn money and I want to put away money for retirement. If you're not doing public service loan forgiveness, or you're not really trying to bring down your payment for income-driven repayment, and you do anything other than the Roth IRA or Roth 403b to a maximum, you're really doing reverse tax planning. So I would hone in on the Roth options before the pre-tax options. But again, general rules are general. And then my last one here is, Given the variability of the market, is this a good time to begin learning how to buy and keep stocks? Well, I would rephrase it. I would say equities, and I probably would not buy individual stocks. Now, this is me. You know, there's a great book. I can send it to you. You can find it. If you Google it, it'll come right up. So there's a guy, his name is William Bernstein. He's an MD, PhD neurologist, turned money manager. And when he was faced with looking at his own retirement savings, he said, I'm going to do the same thing that I do as a physician scientist. I'm going to read the peer-reviewed literature. Well, guess what? There is no peer-reviewed literature in the world of financial planning. So you know the type, MD, PhD neurologist. He created it. So he's a money manager. He's written several books. Everything he has is great. Some of it very technical. Some of it is not so much. What you guys will like is a very quick read. And it's literally like 14 or 15 pages. I think the front and the cover are included in that. And it's called If You Can. And it's really simple. You just go online, you'll pick it up for free, download it. And he basically says investing is like weight loss. Everybody knows, exercise more, eat less. There's plenty of obese people. No one seems to be able to do it. Why is that if it's so easy? It's not that easy. So he talks about investing in low-cost indexed mutual funds, which I'm a big believer in, not trying to buy stocks. It's time in the market, how long you hold something. It's not time in the market. So as a general rule, I'm not a stock guy. I am much more of a passive investor, income index fund investing. So I would definitely read that. There's a good piece, if you Google it, it'll come up. It's from the American Funds Group, just a well-known mutual fund company. And it's called like Louie the Loser and Larry the Winner or something like that. And it basically shows you if you bought the worst day every single year when the prices were the highest, so you're overpaying, versus every day that you bought in every year, you happen to nail it 100%. You got it at the low and you held it. There's really not much of a difference. So I would say it's just going in the market. It's coming up with your spending plan. Ideally, you're going to hate me for this, but from the moment you start residency, you should look to put away 20% of your gross income, which is a lot. But if you do that and you automate this, so money is coming out of your checking account or out of your paycheck and it's going into your 403B, you're not going to miss it. And then you're going to be stuck with this world of problems. When do I retire? Hopefully sooner rather than later. And the more you put away and the more you sacrifice early, the sooner. And the wealthier you're going to be, because it comes down in the beginning, it's all about savings rate. If you're behind the 8 ball, it all becomes about rate of return. And rate of return is what makes people make poor choices and take a lot more risk than they should. It's not because they want to, it's because they have to. So financial education is key. So like I said, if you pick up the White Coat Investor Student Guide, you pick up the first White Coat Investor book, you know, the boot camp might be a little advanced if you don't have a financial education initially. Bill Bernstein's If You Can, like that's probably the only thing you need to read about investing all throughout your residency. And you've got an idea about your student loans, you buy your disability insurance, and you do some kind of investment, whether it's a Roth IRA, Roth 403B, 403B, and get your employment contract reviewed by a competent healthcare attorney when you're graduating. You had a really successful residency and fellowship in addition to getting the medical education that you're longing for. So like I said, it's not difficult. It's just a lot of people hear the terminology and they're so put off by it. But once you get over the initial hump of the technology, it's just concepts. The game doesn't change. It doesn't really get any more complicated. The numbers get bigger. And if you can't explain whatever it is you're doing to someone in a way that you understand it, don't do it. It's probably a recipe for disaster. Make sense?
Yes, thank you so much, Mr. Keller. I am very impressed and grateful. And to those of you who are listening still, I've been putting links in the chat of kind of everything he's been recommending, as well as the links. Anna Marie put the links at the end of his PowerPoint with those for those podcasts. So I'm excited because I have a lot of reading material and
Yes.
podcast material for the week.
Take
Probably
it
the
slow, one step at a time. You start with the basics and you just build on top of it. But White Coat Investor is a phenomenal resource. If you haven't been in there, I just can't say enough of the good that Dr. Jim Dolly has done for the medical community. Another really good one is the Physician Philosopher. So he's a regional anesthesiologist at Wake Forest, so he's academic. He talks about his experience. A lot of his podcast, believe it or not, is wellness. And don't feel trapped in medicine. Here are the things that you can do to get to a better place. And it all kind of comes together. Like, wellness is great, but financial wellness allows you to be well mentally, which allows you to give better patient care to those that you meet. And that's really what it comes down to. So it's almost like that term, like Renaissance man or Renaissance woman. That's really what you want to be. You want to know the medicine, you want to know the money, and you really want to have your mental health on track so you can give the best care to your patients, and you're not stressed out about money, you're not stressed out about your loans. This will actually make you a better physician. So it is worth the investment, and it's not a big investment in terms of your time. So thank you guys so much. I can't thank you enough. If you think of anything, if you have questions, email me. If I don't respond in 5 minutes, it usually means I'm on the phone, and I will respond when I get off. If you need any other resources, do not hesitate to ask. And I really appreciate the opportunity to chat with you guys.
Oh, thank you so much. We're all very grateful to have you. Learned a lot. So thank you for your time. And like he said, everybody, there's his Mr. Keller's email and contact information. So feel free to reach out. Thank you so much.
Awesome. Thank you guys. Have a great night. I appreciate the time.
Bye.
Thank you.
You got it.